Tax season is just around the corner, and if you're stressing out over what you need to do to make sure you file your taxes correctly, in this video, I am going to explain to you what you need to look out for to make sure that you get your taxes filed the proper way. The first thing that you have to consider when thinking about filing your taxes is what type of taxpayer are you going to be? Meaning, how are you going to file your return? Are you going to file as a single individual, meaning no one else is going to be with you on the return? You're going to be the only person on your income tax return because now you make enough money to not be on your parents' return, to file as yourself and not be a dependent on someone else's tax return. So you have to think about your filing status. Is it going to be single? Or perhaps you got married and now you're going to be married filing joint. And that means even if you married on the last day of the year, you are still considered married filing joint for the entire year for tax purposes. That means you're going to file a combined tax return with your spouse and yourself, pulling all your income and all your expenses together on one tax return. But perhaps you decide, you know what, I am married, but I don't want to file with my spouse. The other option would be married filing separately. You do have the right to file a separate tax return even though you are married. The key is going to be that both you and your spouse need to be on the same page with married filing separately. If you're not married filing separately, perhaps you're by yourself, but you have a minor child that you look after, an older adult, or someone that may be special needs. You would fall into the category of head of household. Head of household doesn't mean that you're in charge of the entire house. It just means that you have a dependent on your return. You're single with that dependent. So now you jump into a category of head of household. If you're not head of household, you could possibly be qualifying widower. That means someone who had a spouse, the spouse passed away, but now you have minor children, you would file a qualifying widower. Once you determine the filing status, which is very important because it determines your tax bracket that you're going to be in. It determines how much income is taxed at a certain interest rate. That's the first thing we have to get correct. And once we get that correct, the very next thing we need to consider is what type of taxpayer are you? Are you a taxpayer that has W-2 wages? Are you a taxpayer that has passive income? Are you a taxpayer that's a business owner? Or do you have a combination of all three? Let's talk about each one separately so you can understand the nuances of each one. If you are a wage earner, that means that you are getting W-2 wages. That means you have an employer who is going to issue you a W-2 at the end of the year, and you may have multiple W-2s. It's going to be important that you get all of your W-2s, even if one of your employers went out of business and didn't issue a W-2, you're going to need to have your last pay stub. That's really important. You're going to be considered an earned income filer. The second category is going to be passive income. Perhaps all of your money has been earned off of you maybe holding residential rental property where you have tenants paying you rent. You're not really having to do that much to earn that income. You're getting mailbox money. You're a passive income filer. You're also a passive income filer if your income comes from portfolio income. Portfolio income is like stocks. Portfolio income could give you interest income, anything of that nature. You're considered to be a passive income filer. What if you are a silent investor in someone's business? You're getting money, but you're not actively working in that business. You are considered a passive income filer. And these things become very important because it determines the type of expenses you take. The next category of filing is a business owner. That's somebody that is working a side hustle, somebody that is a 1099 contractor, someone that just does gig jobs, odd jobs every now and then. You're classified as a business filer. And it's important to know what category you're in when it comes to filing your taxes, because that's going to determine what forms you need to use. That's going to determine what deductions you can take, and that's going to determine other things on your tax return, even the amount of tax that you're going to have to pay. The third thing that you want to make sure of is that once you know what type of income you're earning and how you have to file, that's going to tell you what type of deductions you're going to be able to take. If you have all three of those categories, then you're going to really need to pay attention, because you're going to be able to take deductions from all three categories. As a wage earner, your deductions are going to be limited to the standard deduction or itemized deductions. The standard deduction is where the government says, you know what, you get one single amount if you are a single person, married, filing joint, head of household. This is the amount you get to deduct no matter what, and you don't get anything above and beyond that. If you are a wage earner and you can itemize deductions, then you're going to be able to take medical expenses, you're going to be able to take state and local income taxes, you're going to be able to write off your mortgage interest, you're going to be able to take charitable contributions, and some miscellaneous deductions. So understanding the category you're in is very important so you don't leave any money on the table. If you are a passive income earner, your deductions are going to be limited to only those expenses associated with that passive income. For example, if you have a stockbroker or someone managing your stock account, you're going to be able to take your investment expenses only up to the amount of investment income. Really important to understand that. You're not going to be able to take expenses that go beyond your investment income. If you are a business owner, now you're crossing over into a bigger sea of tax write-offs. You're going to be able to take any write-off that is associated with you earning that particular income. Let me give you some examples. Let's say you are a truck driver and you have your own truck. You're going to be able to take the expenses of your truck. You're going to be able to take meals while you're on the road, your cell phone, gasoline, directly against your income. So knowing the type of taxpayer you are determines the type of write-offs you have. It can get a little bit complicated, but just understanding that is really going to help you. If you are a taxpayer that is in all three categories, you earn wages, you have passive income, and you are a business owner, you want to make sure that you get all the write-offs from all three categories so that you can take them against your income. And in order to do that, you want to make certain that you use source documents. So as a W-2 wage earner, you're looking for that W-2 to come in. If you're a passive income earner, you're looking for your 1099-B broker statement to come in from your stocks. You're looking from your K-1 to come in from your passive investments. And if you are just out there running your own business, it's going to be up to you to track your income from all sources, including your third-party payment apps, your Venmo, your PayPal, your Cash App, money going directly into your bank account, because tracking your income is going to be 100% on you. Once you determine your filing status, once you determine the type of taxpayer you are, once you determine your expense categories, now you're well on your way to understanding what you need to do to file your tax return. But it doesn't stop there. You also want to scrape the surface and gather any type of tax credits that you may be entitled to help reduce your tax liability. Allow me to give you some examples of tax credits. If you have children on your tax return, you may be entitled to the child tax credit. The child tax credit can be upwards of $3,600 per child, 6 and below, or $3,000 per child if they are above the age of 6 years old. So you don't want to miss out on any of your tax credits. Also, you can have the dependent care credit. If you need to have somebody watching your children so you can earn income, you don't want to leave off the dependent care credit, which is an actual credit against the amount of the tax that you owe. There's a saver's credit when you save a certain amount of money. There's the educational credits if you're going to school and getting an education. So as a first-time filer, you want to make sure that you look at how you're filing your taxes. If you're single, head of household, married filing joint, married filing separate, you want to look at the type of income you're earning, which categories it's coming from. Perhaps all of them are just one of them. You want to make sure you understand the expenses that are associated with those categories of income. And then you want to make certain you don't leave any credits on the table. When you do that, you're going to be well on your way to making sure you file an accurate tax return, making sure you aggregate all expenses, and making sure that you use every tax credit not to leave any money on the table for Uncle Sam. The first time you file a tax return, it can be a bit overwhelming, but just take your time, get your documentation in place, make sure you validate Social Security numbers of any dependents that are going to be on your return, double check date of birth, get all that good information accurate, and you will have an accurate tax return without a tax slinky. If you enjoyed this video, like, comment, and subscribe. I can't wait to see you on the next video.